Hi everyone and welcome back. In this video we're going to begin working through chapter 4, which focuses on something called adjustments for adjusted gross income, or what we often refer to as adjustments for AGI. So if you remember from earlier in the course when we introduced the income tax formula, we talked about how we start with gross income and then we subtract certain deductions to arrive at adjusted gross income, or AGI. Those deductions that come before we calculate AGI are what we're studying in this chapter. You might also hear these referenced as above the line deductions because they occur earlier in the tax calculation. Now, this might seem like just another step in the formula, but AGI is actually a really important number. A lot of other deductions and credits in the tax system are based on AGI, and many of them begin to phase out once income reaches certain levels, or once your AGI reaches certain levels. So when taxpayers are able to reduce their AGI, it could sometimes have a larger impact than you might expect, because it can make them eligible for additional benefits later on in the return. So as we go through this chapter, I want you to keep that in mind. We're not just learning about individual deductions, we're learning how these deductions fit into the overall structure of the tax system. In this video, I want to focus on two of the more common adjustments. The first one being the student loan interest deduction, and then the second one being health savings account contributions, or HSAs. So let's start with the student loan interest deduction. So many taxpayers have student loans from college or perhaps graduate school, and the tax law allows individuals to deduct some of the interest that they pay on these loans. And the key word here is interest. This deduction does not apply to the total loan payment. So as you know by this time in your accounting career, most loan payments include both principal and interest. And here, only the interest portion is deductible. And the amount of the interest paid during the year is typically reported on Form 1098E, which is issued by the lender. And that's usually the number the taxpayer uses when they're calculating this deduction. In terms of the maximum deduction allowed, it's $2,500 per year. So even if a taxpayer paid more than $2,500 in interest, the deduction cannot exceed that $2,500 limit. Now, when we look at this student loan interest deduction, there's also an income limitation. And this is where the concepts of phase outs come in. So for a single taxpayer, the deduction begins to phase out once their modified adjusted gross income, or modified AGI, reaches $80,000, and it's completely phased out at $95,000. For taxpayers filing jointly, the phase-out range is $165,000 to $195,000. Now, what that means is that if a taxpayer's income falls within that range, they may still qualify for part of that $2,500 deduction, but not the full amount. And once that income exceeds the upper limit, the deduction itself is just no longer available at all. You'll see phase outs like this throughout the tax system, so it's really important to understand the concept even if you don't memorize every number. So let's just kind of walk through a really quick, easy example because this is where students often get tripped up. So suppose a taxpayer makes $4,000 of student loan payments during the year. At first glance, someone might think, I can deduct the $4,000 because that's what I made during the year. But remember, only the interest portion is deductible. So let's say the lender reports that $1,800 of that payment was interest. In that case, the taxpayer can deduct $1,800, assuming that they meet the income requirements. Now let's imagine a different situation. Suppose the lender reports $3,200 of interest, and I think you know where I'm going with this. Even though the taxpayer paid $3,200 of interest during the year, that deduction is still limited to $2,500 because that's the maximum that's allowed. So there are really three things to think about here. First, how much interest was actually paid during the year? Not loan payments, but how much of those loan payments represents interest. The second is, what is the cap? And that cap is $2,500. And then the third would be, where does it phase out? Does it begin phasing out? Are any amounts phased out from what I can take as a deduction, or am I even within the range that I'm allowed to take a deduction at all? All three of these can affect the final deduction. And then finally, another important point is that this deduction is taken before AGI, which means taxpayers can take it even if they use the standard deduction. And that's one of the key advantages of adjustments for AGI. Now let's move to the second topic in this video, which is health savings accounts, or HSAs. HSAs are accounts designed to help individuals save money for medical expenses, and they receive very favorable tax treatment. However, not everyone qualifies to contribute to an HSA. To be eligible for an HSA, the taxpayer must be enrolled in what is called a high deductible health plan, and that's often abbreviated as HDHP. So let's take a minute to talk about what that actually means. A high deductible health plan is defined by the IRS using minimum deductible thresholds and maximum out-of-pocket limits. So for example, for 2025, a plan generally qualifies as an HDHP, or high deductible health plan, if the annual deductible is at least about 16, not about, excuse me, if the annual deductible is $1,650 for individuals or $3,300 for family coverage. And these amounts, they can change slightly each year. They're often indexed for inflation, but the key idea is that the plan must require the taxpayer to pay a higher deductible before their insurance coverage kicks in. So not every health insurance plan qualifies. It must meet those specific IRS thresholds. So before we wrap up, I want to briefly connect these deductions back to the income tax formula. Both the student loan interest deduction and the HSA contributions are examples of adjustments for AGI. And that means they reduce income before we calculate adjusted gross income. Because AGI is used in so many other calculations, lowering AGI can sometimes make taxpayers eligible for additional deductions or credits. So even though these deductions may not seem large on their own, they can have a broader impact. So that brings us to the end of this first video for Chapter 4. In the next video, we'll cover working through adjustments for AGI and focus on deductions related to self-employment, including the deduction for half of self-employment tax and self-employment insurance. As you go through the reading and the assignments for this chapter, try to focus on how each of these deductions fits into the overall tax formula and what limitations apply. As always, if you have any questions, just reach out and I'll see you in the next video. Thanks.